They did it again. Last week, the Federal Reserve paused interest rate hikes and mortgage rates immediately went up higher for 2 days in a row. Jerome Powell and the Federal Reserve last Wednesday left themselves room for a possible rate hike in November. So the question is, if they know they might need to leave room to raise rates in November, then why not raise rates right now? Do they think that they have finally accomplished their stated goals and we just need more time in order for all those target metrics to be hit? Are they concerned that maybe they went too far and that all lagging indicators will be showing up at the same time, or possibly now too quickly? Or is there another reason that they haven't stated that's causing them to leave themselves some wiggle room in order to raise rates in November? And if they do raise rates in November, then that means that the data is not in support of what they need it to be in order to have done that at this last meeting. Despite everyone saying what it makes sense, when you look at the details, it really doesn't make sense, does it? It's almost like they're saying, oh, oops, we should have done this one last time in September, and since we didn't, now we have a mistake and we have to compensate for it. Great. And that leads me to what we'll be talking about next. What does the future of mortgage and real estate look like if the Federal Reserve themselves are saying that they have to leave interest rates higher for longer and that the lagging effects of monetary policy decisions have yet to make their full impact on the economy? Simply stated, this means that they are waiting for unemployment to continue cooling and for inflation to get closer to 2% before they make their next rate decision. And that's not even the unsettling part. The unsettling part is that 2024 could be a year where they keep rates exactly where they're at without even being able to offer the markets or the economy a rate reduction. And why is that, Andy? Because it's taken us 18 months to get this far, and if they raise rates in November, then it'll be 20 months since their initial rate hikes began in March of 2022. And that means it could take that same amount of time to finally end their prescribed course of fiscal policy tightening. Then, now we're not talking about rate cuts until 2025. That could be too late. Expect rate cuts to start in 2024, because that's when we're going to need them. Look, I really want to believe that the Fed has chosen the lesser of two evils when it comes to battling inflation and trying to restore price stability in the markets. However, this little exercise over the last year and a half has been very challenging for so many reasons. Not to mention mortgage and real estate being in the direct line of fire with those policy changes. We have historic unaffordability, interest rates the highest they've been in 23 years, delinquencies the lowest in 27 years because of the mortgage market refinancing half the country with the lowest mortgage rates we've ever seen back in 21 and 2022. Which also happen to be the two highest years of mortgage origination volume ever recorded in history. Coupled to those things, we have a resilient consumer and continued spending, even if it is with credit cards. We have seen inflation recently kind of bottom out and has made an uptick that now leaves us asking, when will we actually see true decline that they've been asking for? So here's 3 things you want to be watching for between now and the Federal Reserve's next meeting in November 2023. Number 1, core PCE. This is the Fed's favorite measurement of inflation, and it needs to get as close to 2% as possible as quickly as possible. Anything above 3% is still a threat to their overall goal. Number 2, we need to see unemployment getting closer to 4.5%. Yes, I know that sounds painful, and I know that means a lot of people are going to face financial duress. However, this is exactly what they've been telling us they need to happen in order to reduce the amount of dollars in the economy chasing the amount of goods being sold. Number 3, we need to see fewer job openings and more early retirements, which both eliminate the total number of Americans in the workforce. The secondary effects of this ultimately help price stability restore, because when demand cools, prices have to come down. We're just gonna have to wait. However, these are 3 key indicators that are primary for the Fed to see that they're making progress so that they pause rate hikes in November rather than raise them one final time. So with that, let's take a look at what's coming up in the markets this week. Monday, Fed member Neil Kashkari speaks and will likely only parrot what Jerome Powell told us last week. Tuesday, consumer confidence and new home sales both come out. Wednesday, we get durable goods orders and core durable goods orders. Thursday, final GDP quarter over quarter is released. This will be important for knowing whether or not we can achieve a soft landing or if we have trouble brewing on the horizon. We also get unemployment claims, pending home sales, and Fed Chair Jerome Powell speaks. Don't expect him to say anything different. He's gonna play this one pretty darn safe. And on Friday, core PCE index and revised consumer sentiment both come out. Keep one eye open on that one. Revisions can sometimes be tricky, and in recent history, some revisions have been really ugly. But since they're not the most popular topic of the day, the powers that be can get away with sneaking really bad news into these rear-view looking data points. And that's it for this week. Remember to like this video, subscribe to the channel, and turn on notifications so you catch every episode.